These are the wars, pandemics, and other shocks that have marred my 30-year career as a financial advisor. I remember every one of them and more. Each long-term investor will experience headline risk in troubling times, but the crises you face will be unique to the time you're investing. The old saying is, while history doesn't repeat itself, it does often rhyme. What's most difficult to sort out is how much you can rely on past data for guidance in making decisions for today. In this video, we're going to look at some past statistics around these events and see if past information would have been helpful. Welcome to the RhinoInvestor.com educational series. Like and subscribe to charge along with us. Let's start with past health scares. In general, these events tend to be sharp yet short-lived. What strikes me about each one is how scary they were at the time, and yet how we barely remember them now. For example, remember the anthrax scare? I think it gets lost in our memory because it happened right after 9/11. It was a bioterrorism attack of anthrax spores in the mail, and there was a run on Cipro because it was the only antibiotic that would cure it. Each one of these health scares had us gripped in fear for a short period of time, but were ultimately contained. So when another novel coronavirus started in the news in late 2019, history was on our side to ride out the short-term panic. From mid-February to mid-April of 2020, the S&P 500 lost 34%. I was in the V-shaped recovery camp at the time, and that's just what happened when the S&P rebounded 45% April to June. Because once markets digest and assess the bad news, it looks to the future, so that reaction made sense to me. What felt more unpredictable was the potential impact of the unprecedented lockdowns. Economists had theorized, and I believe it's been proven, that we can't just shut down a large and complicated economy and try to restart it later without permanent damage. Supply chain issues, shifting demand, and large economic stimulus have created new issues for our markets today that have less to do with COVID-19 and more to how we responded to the threat. The lesson with health scares shows us that a short-term panic usually corrects itself quickly, so it's best to stay away from the panic while it's happening, let the market settle, and reassess. Sometimes we don't need to change anything because the scare had little to no permanent damage. In a time like COVID that created so much change, it may be prudent to rebalance into areas of the market that reflect that change and your personal impact as well. The next area we'll look at that scares investors is war and terrorist attacks. I only listed a handful of them here because sadly, we've had more terrorist attacks and invasions in our country and around the world in the past 30 years than I can list. Market statistics on war are closely tied to whether or not the event was expected. If a war starts after a period of tensions, the market generally goes down in anticipation of war and up at the start of it. If an attack or invasion is unanticipated, a sharp decline occurs initially, followed by a usual strong recovery. These results can look similar to health scares. And while certain sectors of the economy may do better or worse with each headline, the overall stock market typically reacts the same way. Because remember, markets can absorb and handle bad times. What it doesn't like is uncertainty. Even if the news is bad, it feels more certain, and markets move forward with more confidence. So these rare, unexpected events are what we in the financial industry call a black swan. And they don't just come in the form of invasions and health scares. A black swan event can be anything unpredicted with large consequences. An unbelievably large Ponzi scheme, election uncertainty, unprecedented natural disaster damage. A black swan event can be quick, like the flash crash in 2010, a day when the Dow Jones fell 10% and then recovered in just moments. Or it can be long and slow, like having zero to near zero interest rates for a decade and a half. And of course, inflation like we haven't seen it in 40 years. So what's the takeaway for investors after a walk down this memory lane? The first and probably most important rule is remain calm in a panic. While there are no guarantees, history shows us we typically have a rebound and time to assess any necessary changes when the panic is over. The second lesson would be bad times and unexpected events have been and will always remain with us. We can't predict exactly what those events may be, but we can predict that they will happen. Prepare for them now by diversifying and keeping enough safe money set aside to get you through rough times. And of course, the stock market is never a guarantee. It can be volatile and unpredictable in the short term, and even experts that have a good track record of past results can get it wrong in the future. Only put into stocks what you predict you'll leave invested for 10 or more years for best results. And the fourth lesson that I really like to remember is that the stock market is not the only game in town. There are many more investment choices and ways to invest. A little homework can go a long way, and so can working with a trusted advisor. Our world is ever changing, but our philosophy of investing is steadfast. Stay calm, stay diversified, take on only calculated risks. As financial advisors, we're taught to adhere to the prudent person rule. This is something that can help all of us, no matter what life throws us as investors in the future. Feel free to email me directly with questions about your financial plan. As a financial advisor since 1992, I'm happy to help you reach your goals.